There are three types of financial decisions people need to make. The first one being investment and capital budgeting decision. Second one, financing and capital structure decision. And third one is payout policy for a company. So the first one, investment/capital budgeting decision, that's more to do with how to raise funds in order to put it to productive use. This is to do with module 3, financing and evaluating investments, because we go through the sources of funds, so short-term and intermediate funding and all that kind of stuff. Whereas module 2, that's to do with financing and capital structure decisions. The types of funds raised in the form of debt, equity, and hybrid securities to finance investment opportunities. Yeah, I'll go with module 2 first, which is management of liquidity, debt, and equity. First, we go through the Basel III. This is international regulation banking industry had to implement. And there are two key minimum standards for liquidity risk. The first one being liquidity coverage ratio, LCR. And second one was net stable funding ratio. LCR is to ensure that bank has sufficient high quality liquid assets to survive 30 days without additional funding. Whereas net stable funding ratio, so that's NSFR, that's to see if it's gonna last for 1 year. And for liquidity coverage ratio, there are two tiers of assets. Tier 1 assets encompass cash, central bank reserves that can be drawn down in times of stress, certain categories of government debt. Tier 2 assets are the highly rated corporate bonds issued by non-bank issuers. So this is more like obscure, lower quality type of asset than tier 1. This also covers bonds, certain categories of government debts like the tier 1. And for the purpose of LCR, this should not make up more than 40% of the overall liquidity asset pool. Which makes sense because you want to have more stronger and secure type of assets in the bank. So minimum capital adequacy requirements set for authorized deposit taking in Australia. So the standard says you need to have 4.5% of common equity tier 1 for the ADIs to operate in Australia, 6% of tier 1 capital ratio, and 8% of total capital ratio. So obviously I'm not gonna remember this and I'm gonna look at the notes while I'm doing my test. But I think it's something to keep in mind because one of the questions in the practice test had this kind of question and I was like, what the hell are they talking about? But let's look at part A, cash flow management. So cash flow management is to ensure that its debt obligations can be adequately met both now and in the future. So it's to do with having enough cash flow to meet the obligation to pay off those debts. Firstly, liquidity management. Liquidity is the capability of an organization to convert financial assets and financial facilities into cash. With respect to cash flows, the ability of an organization to meet its current debt obligations. So, cost of liquidity management. Opportunity cost of holding surplus cash investments. If you have too much investment, then there's opportunity cost of holding those cash investments. Financial facility costs for surplus facilities. You need to incur your finance facility cost for having too much cash in your facility. Interest cost of surplus borrowing. So if you borrow too much, then you need to pay interest more than enough. So how to measure liquidity? The ratios to measure liquidity. There's current ratio, which is current asset divided by current liability, CA divided by CL. Whereas quick ratio, this includes inventory, so current asset minus inventory divided by current liabilities. Then we go to cash management, which is to do with near cash holdings. Example are at call money market and bank deposits, bank bills, and promissory notes. So things that they go through regarding cash management are forecasting and planning, carrying out daily cash procedures such as daily account balance monitoring and reconciliation, daily cash flow plan, concentrating surplus cash balances to offset against any accounts requiring fundings. Third one would be centralizing intercompany flows with treasuries, centralizing and investing surplus funds, implementing cash-based performance measures. So this is just more cash management. This isn't really technical stuff, it's just more like how are you gonna manage your cash? So that's something that I'm not really interested in. I mean, I do care. I'm an accountant, so I do care, but there's not much to really memorize from this, so I guess I'll just just skim through this. There's cash disbursements. Two objectives of cash disbursements is to seek to ensure that cash is disbursed on a timely basis to the correct creditor. Second one will be appropriate controls are in place to mitigate any potential fraud by employees. So the first one is disbursing in timely basis. Second one is mitigating potential fraud. So procedures to achieve those objectives. This is to do with internal control again, proper authorization of transactions, segregation of duties, design and use of adequate documents and records, access to assets and records, independent checks. We're gonna have a look at free cash flow. This is one of the important subtopics in this module. So what's free cash flow? It's organizations operating cash flow after it has invested in new capital and before the effects of any new debt. So this is an after-tax cash flow available to shareholders if the company had no debt. Free cash flow means after tax. This is a measure of cash remaining, assuming that new investment capital has come from internal cash flow rather than additional debt or equity. So how do we calculate free cash flow? Free cash flow equals net income plus depreciation and amortization minus changes in net working capital minus capital expenditure. Obviously, I'm gonna look up this formula when there's a question about this in the exam, but it's good to remember it. It's good to go through this together. We'll just have a look at the elements inside the free cash flow. So net income, that is accrual concept. As we said, free cash flow is an after-tax cash flow available to shareholders. Depreciation and amortization, because we need to add back the non-cash expenses related to the prior cash outflows. Changes in net working capital, we're minusing this because this increase relates to the growth of the organization, and this means it requires more cash to fund this growth. If there's a growth in the organization, then we will minus, assuming that they need more cash to fund this growth. Whereas if there's a decrease in net working capital, that means we're gonna add back to obtain free cash flows. In order to calculate your net working capital, so working capital is current asset minus current liabilities. And lastly, capital expenditure. This will no longer be available to the external provider, so we're just minusing this. So stress testing, let's see where this goes. So the issues that organizations need to avoid: margin erosion, so when the ratio of sales to expenses falls. Margin is gross profit, so if the gross profit falls, then there's a margin erosion. High gearing, if there is a debt that is over leveraged or the equity base is eroded. Undercapitalization, when there's an insufficient equity. Lack of cash flow forecasting. Difficulty to meet cash obligations such as paying GST or PAYG installment tax. So all that kind of issues that organizations need to avoid needs to be considered. The key questions that needs to be considered are: what is the break-even level for the business? What is the effect on revenue and earnings if the company loses 10% of sales or major clients? This is something that all companies need to think about when they're operating their business. How is average receivable days outstanding tracking? What would trigger a staff cut? What overheads will be reduced and what measures will be taken to preserve cash? What non-core assets could be sold to reduce debt and provide additional cash flow? What needs to be done to meet ongoing tax requirements? So all these kind of quick questions needs to be asked. I don't know how this relates to the stress testing. I think it's just a broad, like a general questions that companies need to think about. But yeah, anyways. So I guess the main thing about part A, cash flow management, was to do with free cash flow and yeah, how to calculate free cash flow, and working capital management will be talked about now. So part B, working capital management. This is to help the company hold on to cash for as long as it is commercially acceptable. So if you're trying to hold on to your cash as commercially possible, also to defer payment of expenses for as long as it is commercially viable. Strategies to manage working capital. There are two examples that we can come up with right now. Factoring and sales and leaseback. What are they? Factoring is when an intermediary agent that provides cash or funding to a company is purchasing their accounts receivable. So when someone buys your debtor accounts receivable, that's factoring. But you're selling your debtors at a discounted price. That's factoring. Sales and leaseback is when a company sell an asset to raise capital, then lease your asset back from the purchaser. So you're selling an asset, but then you're leasing back from the person you bought it from. Other methods of adjusting cash flow. You can negotiate trading terms with creditors. So you will want to defer it as long as possible. Collecting receivables in the shortest time possible. If you want people to pay you faster, then you will want to offer payment options or have additional charges for late payments. But you can outsource debt collecting services. You want to turn over inventory in the shortest possible time because you don't want to keep your inventory for a long time. You can enable work in process to be completed in the shortest length of time. Maybe you can tell people to work faster. I don't know how you can do that. Maybe AI. So how do you measure working capital requirements? In order to calculate the cash conversion cycle, we'll look at the different elements inside. So how do you calculate days of sales outstanding? This is accounts receivable divided by revenue or sales divided by 365 days. In Australia, it's 365 days. And then there's days of inventory outstanding. This will be inventory divided by cost of goods sold divided by 365. So if you have days of sales outstanding plus days of inventory outstanding, if you combine that, DSO plus DIO is operating cycle. So company buys the inventory and then sells the inventory. That's the inventory cycle, yeah? The time company sells the inventory and company receives the payment, that's the accounts receivable period. So if you combine that, then that's the operating cycle. From the moment you purchase the inventory to the moment you receive your cash from the sale of this product, that's the operating cycle. And then we're gonna look at the days of payables outstanding. That's accounts payable divided by cost of goods sold divided by 365 days. So that will be when the company buys the inventory to when the company pays for the inventory. So if you want to calculate the cash conversion cycle, then you will want the operating cycle minus the days of payables outstanding. So DSO plus DIO minus DPO. That will be the moment you paid for the inventory to the moment you received cash. Whereas operating cycle, when you bought the inventory, and then when you receive cash. So the difference will be buying the inventory, but then you didn't actually physically pay with your cash. Just because you bought it doesn't mean you actually paid the physical cash. So if you have a negative cash cycle, this means you received cash from the customers before you paid for the products to the suppliers. So that means your accounts payable days is more than your operating cycle days, which is better because you want to defer your payments as long as possible. That's why Afterpay, PayPal, and all that kind of buy now, pay later, BNPL cards are on trend because you want to defer your payments as long as possible. But then you want to have the products as soon as possible. We're gonna look at the funding risk and credit risk assessment. Funding risk is when an organization will be unable to meet its obligations due to capital risk and liquidity risk. What's a capital risk? It's the risk that an organization has insufficient capital to support its business operations or to achieve required capital ratios. So let's look at some financial ratios and credit rating. What is interest coverage ratio? That's EBIT, earnings before interest and tax, divided by interest expenses, interest coverage ratio. Free cash flow, that's the amount of cash generated by a company's operations. Well, we went through this just then. Quick ratio, that's ratio of current non-inventory items that can be turned into cash immediately. Yeah, because you have to minus inventory. Debt to equity ratio, that's the extent of debt relative to the owner's own capital commitment to a business. Debt to asset ratio is the extent of debt relative to the sum of the debt and equity used in the business. Financiers' lending decisions. So there's a probability of default. So how likely it is that the borrower will be unable to meet its debt servicing requirements or loss given default. How much of the loan and liabilities will likely need to be written off? What are the exit strategies? There are 4 exit strategies. Primary source of repayments. So primary exit, where cash generated by parent guarantor in the normal course of business. Alternative PSOR, so PSOR is the primary source of repayment, when there's a sale of borrower. Secondary source of repayment, so the secondary exit is when refinancing by banks at group level. Alternative secondary exit is when you sell down of the debt by coordinating arranger in the secondary market. So you can exit your funding through these exit strategies. Part C, cost of capital and capital structure. Last time we talked about qualitative and quantitative factors that we consider when there's cost of capital and capital structure. So for qualitative factors, there are 7 that we're gonna discuss. Nature of assets, stability of earnings, flexibility, control, risk, cost, and external constraints. Let's go through each of them. Nature of assets, when there's a relatively predictable stream of cash flow. That means you can employ higher level of debt. Stability of earnings, for example, finance companies carry higher debt than manufacturing companies because they have the stability of earnings. It's the same thing as the first one though. Flexibility, that has more flexibility than equity because it can be repaid or withdrawn in varying amount at any time. Control, equity carries benefits / risk of ownership. They cannot default. Risk, that creates a fixed obligation, including repayments and interest rate risk. Cost, for company, so the perspective of company, that is cheaper because borrower makes interest payment and repayment at maturity, and the interest expense is tax deductible as well. External constraints of banks and other lenders, dominant shareholders, and rating agencies. Yeah, so that's the qualitative factors. The quantitative factors, how to calculate cost of debt. Now, from here, this is when the mathematical formulas are gonna be used. If you wanna calculate cost of debt and it has year to maturity of 1 year, then you would do coupon payment plus face value of the bond divided by the current market price of the debt. Okay, cost of equity. This is to do with cost of the company raising funds using equity. There's 2 types of risk, systematic risk and unsystematic risk. Systematic risk is to do with market risk or non-diversifiable risk. For example, market risks such as unexpected interest rate movements. That's a market risk. Whereas unsystematic risk, that's unique diversifiable risk. So this is a risk that is unique to the company, such as a company CFO resigning. That's a unique risk. So if you put this into standard deviation, if it has lower risk and there's less dispersion in its return or unexpected return. We're gonna look at the portfolio theory. So this is a theory that assumes that the investors hold large, well-diversified portfolios of securities, and this diversification can be achieved without cost. So that is assuming that investors can eliminate the unsystematic risk through portfolio diversification. I guess in this theory, we're assuming that we're only focusing on the systematic risk, so only market risk, because we are assuming that investors are smart enough to diversify their portfolios, so put eggs in different baskets to eliminate the unique unsystematic risk. Okay, that's good. That's good that they assume that we're smart. Okay, so capital asset pricing model. That is the relationship between a security's systematic risk and its required return. So there's 3 main assumptions about investors. It's the same as portfolio theory. We're assuming that the investors are risk averse. This means that there's additional returns required for assuming that there's additional systematic risk. If you know that there's more risk, then you want higher return. We're also assuming that investors hold well-diversified portfolios so that the security-specific unsystematic risk is eliminated. And also there's a homogeneous belief about risk and expected return attributes to all publicly traded securities. How do you calculate the cost of equity? you need risk-free interest rate, so that's the treasury bond rate, plus expected return on market portfolio minus risk-free rate times the beta, which is the systematic risk, the market risk. The expected return on market portfolio minus risk-free rate is actually the expected market risk premium. So the cost of equity is risk-free rate plus expected market risk premium times beta. So we're gonna look at cost of preference shares. So preference shares, they pay fixed dividend and they're typically non-voting shares. If a preference share is non-redeemable, so if it doesn't have a maturity date, then it can be valued as a simple perpetuity. In order to calculate the cost of preference shares, it will be annual dividend divided by current market yield. So P equals D divided by K. In order to calculate the weighted average cost of capital, you need cost of debt, cost of preference shares, cost of equity, and then you have market value of all of those. So in order to calculate WACC, you need cost of debt times market value of debt divided by total market value of the company. So market value of company debt, market value of company preference shares, and company equity. So that's the formula. There are 3 steps when calculating WACC. First, identify the financing components. Then you gotta determine the market values of these financing components. And then you gotta find the percentage of how much debt, equity, and preference shares you wanna have. We're assuming that that has the lowest risk because company has to meet its debt obligation. When there's a crisis, you need to pay off your creditors first, and then preference shares because they're above the ordinary shareholders. And then the last one is ordinary shareholders. So ordinary shareholders have the highest risk. And when you calculate the after-tax WACC, that's when you multiply 1 minus T, 1 minus tax. So if the tax rate is 30% for company, then you times 70% to cost of debt because there's a tax deductibility of interest on debt. So we're assuming that there's a lower cost of debt to the company. Okay, so we just went through module 2. Oh, my throat hurts already, but I guess the important aspects of module 2 would be current ratio, quick ratio, free cash flows, cash conversion cycle, and WACC. So cost of debt, cost of preference shares, cost of equity. Cost of equity, you find that through capital asset pricing model, and also after tax weighted average cost of capital. So I guess this is the main things we need to think about when we're doing module 2. Now we're gonna look at module 3.